Have you been watching gold lately? Because something extraordinary just happened that hasn't occurred since the financial crisis of 2008. Gold just broke above $4,100 an ounce, sending a rare market signal that has historically preceded massive economic shifts. The last time we saw this particular pattern, it changed the financial landscape for an entire generation. Let me take you back for a moment. In late 2007, gold began a peculiar trading pattern, a sustained breakout above previous resistance coupled with unusual central bank activity. What followed was the greatest financial crisis since the Great Depression. But those who recognized this rare signal had the opportunity to not just preserve their wealth, but multiply it. Today, we're seeing an almost identical pattern unfold. Gold has rallied 57% this year alone, breaking through every technical resistance level with remarkable strength. But this isn't just about price. It's about what's happening beneath the surface, the mechanics of the gold market that most retail investors never see. Let's start with what's happening at the COMEX. For the first time in over a decade, we're seeing a dramatic shift in the futures curve. The backwardation, where spot prices exceed futures prices, has reached levels not seen since 2008. This is extraordinarily rare in commodity markets and signals severe physical supply constraints. When physical gold becomes this scarce relative to paper contracts, something significant is brewing. Meanwhile, the LBMA in London is experiencing unprecedented physical outflows. Their latest reporting shows gold inventories have dropped to the lowest levels since record-keeping began. The ratio of paper gold to physical gold has exploded to over 200 to 1. Think about that for a moment. For every ounce of physical gold in the vaults, there are 200 paper claims against it. This is a precarious situation that cannot mathematically sustain itself. But perhaps most telling is what central banks are doing. They've been on a gold buying spree that makes previous accumulation periods look trivial by comparison. China added another 27 tons last month alone, bringing their official reserves to over 2,300 tons. Russia has more than doubled its gold reserves in the past 5 years. Even countries like Poland, Hungary, and Turkey have dramatically increased their gold holdings. Why would central banks be accumulating gold at the fastest pace in history if they believed in the stability of the current monetary system? They wouldn't. They're preparing for something, a major reset in the global financial architecture. Let's look at the technical picture. Gold has formed what analysts call a cup and handle formation on the monthly chart, one of the most powerful continuation patterns in technical analysis. The measured move from this formation suggests a target of $5,200 per ounce. But even that may be conservative, given the fundamental drivers at play. Speaking of fundamentals, global mine production has plateaued despite these higher prices. The world's largest gold miners are reporting declining ore grades and increasing extraction costs. South Africa, once the world's largest gold producer, has seen its output fall by over 85% from its peak. The easy gold has been found. What remains is increasingly difficult and expensive to extract. Then there's the demand side of the equation. Investment demand has surged 43% year over year, according to the World Gold Council. ETF inflows have reversed their previous outflows, with over 300 tons of new investment in the past quarter alone. But retail demand is where we're seeing the most dramatic shift. Premiums for physical gold coins and bars have reached unprecedented levels, with some dealers reporting wait times of 8 to 12 weeks for certain products. And it's not just Western investors. In China, the Shanghai Gold Exchange is seeing record volumes. Indian gold imports have surged despite higher duties. The global east-to-west flow of gold that has persisted for decades is reversing before our eyes. Now, let's talk about what happened the last time we saw this signal. In 2008, gold initially fell along with other assets as margin calls forced liquidations across the board. But it was the first asset to recover, beginning a bull run that would see it rise from $700 to over $1,900 by 2011. Those who recognized the signal and positioned accordingly saw gains of over 170%, while most other investments were still underwater. But the current situation has additional factors that weren't present in 2008. For one, we're seeing unprecedented de-dollarization efforts across the globe. The BRICS nations are actively working to create alternative payment systems that bypass the US dollar. Russia and China have already reduced their dollar usage in bilateral trade by over 90%. Saudi Arabia is now accepting yuan for oil sales to China, a direct threat to the petrodollar system that has underpinned American financial dominance since the 1970s. This brings us to an important historical parallel. In 1971, when President Nixon closed the gold window and ended the Bretton Woods system, gold was trading at $35 per ounce. By 1980, it had reached $850, a 24-fold increase. The monetary system had fundamentally changed, and gold repriced accordingly. Today, we're witnessing similar tectonic shifts in the global monetary order. The Federal Reserve's balance sheet has expanded from $800 billion before the 2008 crisis to nearly $8 trillion today. Global debt has exploded to over $300 trillion, more than 3 times global GDP. These numbers are so large they've become almost meaningless to the average person, but their implications are profound. And that's why central banks are accumulating at record pace. They understand what's coming. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to where this price is headed next. The institutional positioning in the gold market tells us something big is brewing. Commercial short positions, typically held by banks, have reached extreme levels. Historically, this would be a contrarian indicator suggesting a potential pullback. But here's where it gets interesting. Despite these large short positions, the price continues to rise. This suggests powerful buying pressure that's overwhelming even the most sophisticated market participants. Let me tell you about what happened in 1980, when gold hit its previous inflation-adjusted high. Paul Volcker had just taken over as Federal Reserve Chairman and was facing runaway inflation. His solution was to raise interest rates to unprecedented levels, eventually reaching 20%. This crushed inflation, but also triggered a severe recession. Gold initially fell sharply as real interest rates soared. Today's Fed faces a similar inflation problem, but with a crucial difference. The debt levels make a Volcker-style interest rate policy impossible. The U.S. government simply cannot afford to service its debt at double-digit interest rates. This creates a situation where negative real rates, nominal rates minus inflation, are likely to persist for years to come. And negative real rates have historically been rocket fuel for gold prices. What about the dollar's reserve currency status? Many analysts point to the dollar's continued dominance as a reason to dismiss gold's rise. But reserve currency transitions don't happen overnight. They unfold over decades. The British pound remained an important reserve currency for years after the UK's economic dominance had faded. We're seeing a similar gradual transition away from dollar hegemony today. The International Monetary Fund recently reported that the dollar's share of global reserves has fallen to 59%, the lowest level in 25 years. Meanwhile, central bank gold reserves have increased for 13 consecutive quarters. They're voting with their vaults, not their words. Now let's examine what's happening with institutional investors. Ray Dalio, founder of the world's largest hedge fund, has been vocal about his concerns regarding monetary policy and has allocated significantly to gold. Stanley Druckenmiller, George Soros, and other legendary investors have also increased their gold exposure. These are not gold bugs or perma-bears. They're pragmatic investors who see the writing on the wall. But perhaps the most telling institutional move comes from BlackRock, the world's largest asset manager. They recently launched a tokenized gold product, bringing gold into the digital asset ecosystem. This opens the door to a new generation of investors and creates additional demand vectors for physical gold. What about mining stocks? Historically, gold miners provide leverage to the gold price, outperforming the metal itself during bull markets. The current situation is particularly favorable for miners. Many have spent the past decade improving their balance sheets and operational efficiency. With all-in sustaining costs averaging around $1,200 per ounce, the current gold price provides extraordinary margins. Free cash flow yields for major miners are approaching double digits, levels rarely seen in the sector. Let's talk about timing. Market signals like the one we're seeing don't come with expiration dates. The unwinding of the current monetary system could take months or years to fully play out. but certain trigger events could accelerate the timeline dramatically. One potential catalyst would be a sovereign debt crisis. Japan, with government debt exceeding 260% of GDP and a rapidly aging population, is particularly vulnerable. A crisis there could quickly spread to other debt-laden economies. Another potential trigger would be a significant geopolitical event that accelerates de-dollarization efforts. But perhaps the most likely catalyst is simply the mathematics of debt service. As the Fed has raised rates, interest payments on U.S. government debt have surged to record levels. They now exceed the entire defense budget. As existing debt rolls over at higher rates, this problem compounds. At some point, the choice becomes default or debasement. History suggests governments almost always choose the latter. What does all this mean for you? First, understand that we're witnessing a historic shift in the global monetary order. The rare signal gold just sent is not just about a price move. It's about a fundamental revaluation of all financial assets relative to hard assets. Second, recognize that traditional portfolio allocations may not provide the protection they once did. The 60-40 stock-bond portfolio that served investors well for decades is based on assumptions about correlation that may no longer hold in the new regime. Third, consider how gold might fit into your own financial situation. Physical gold provides no yield and has storage costs, but it also has no counterparty risk, a feature that becomes increasingly valuable during systemic stress. Let me share a story from 2008 that illustrates why this matters. I had a client, let's call him Robert, who had built a successful manufacturing business over 30 years. His retirement portfolio was diversified across stocks, bonds, and real estate. When the crisis hit, his stock portfolio fell by over 50%. His real estate investments became illiquid overnight. Even some of his safe bond investments faced severe stress as credit markets froze. But Robert had also allocated about 20% of his portfolio to physical gold and silver, stored securely outside the banking system. While everything else was crumbling, this portion of his wealth not only preserved its value, but appreciated significantly. It gave him the liquidity and confidence to make it through the crisis without being forced to sell other assets at distressed prices. When the recovery eventually came, he was positioned to benefit fully. The lesson isn't that gold is a magic solution. It isn't. But in times of systemic stress, it provides unique benefits that few other assets can match. Now, let's address some common objections. Critics often point to gold's lack of yield as a fatal flaw. It just sits there, they say. But in a world of financial repression where real yields on supposedly safe government bonds are negative, gold's zero yield actually looks attractive by comparison. Others argue that gold is an antiquated relic in our digital age. But the enduring value of gold across thousands of years and hundreds of civilizations suggests otherwise. Its physical properties, durability, divisibility, consistency, and above all, scarcity, make it uniquely suited as a store of value. Bitcoin and other digital assets may indeed capture some of gold's monetary premium, but they come with their own unique risks and trade-offs. Some point to previous false alarms in the gold market as reason for skepticism. And it's true, gold has had its share of failed breakouts and disappointed bulls over the decades. But the current macroeconomic backdrop is unprecedented in modern financial history. The combination of record debt levels, persistent inflation pressures, geopolitical realignment, and central bank gold accumulation creates a perfect storm for gold that we haven't seen before. As we look ahead, it's worth considering what the end game might be. Some analysts suggest we're heading toward a new Bretton Woods-type agreement, a formal restructuring of the international monetary system. Others believe the transition will be more gradual and organic. Either way, gold is likely to play a central role in whatever comes next. The World Gold Council recently published a fascinating study on gold's performance during various monetary regimes throughout history. Their conclusion was striking. During periods of monetary transition, gold has consistently outperformed all other asset classes by a wide margin. So what should you do with this information? First, stay informed. The financial media often misses or misinterprets the significance of developments in the gold market. Develop your own sources of information and analysis. Second, consider your time horizon. Gold has proven to be an excellent store of value over long periods, but it can be volatile in the short term. Any allocation should be sized appropriately for your personal financial situation and risk tolerance. Third, Think about form and custody. Physical gold offers different benefits and risks compared to ETFs, mining stocks, or futures contracts. Where and how your gold exposure is held matters greatly during times of financial stress. The rare signal gold just sent deserves your attention. Throughout history, gold has had an uncanny ability to sniff out monetary disorder before it becomes obvious to the broader market. The last time we saw this particular configuration, it preceded a generational shift in the financial landscape. Whether this transition unfolds quickly or slowly, the prudent move is to be prepared rather than reactive. Those who understand the significance of what's happening in the gold market today have an opportunity to position themselves advantageously for what comes next. The writing is on the wall for those willing to see it. The question is not whether the current monetary system will change. It's already changing before our eyes. The question is how well positioned you'll be when the dust settles. History suggests that those who heed gold's warning will navigate the transition far better than those who ignore it.